In this video, we'll try to understand the classification of finance lease and operating lease. Now, what is a finance lease and what is an operating lease? So far, in our discussion of a lessee accounting, we did not have to bifurcate between a finance lease and an operating lease, because for a lessee, all kind of leases are treated in the same way, and they are treated as a finance lease. They are treated as if the lessee actually purchased an asset on credit and then repaid the amount with interest. But in the case of lessor, except for certain exceptions, in the case of lessee, there were certain exceptions that if the lease is for a very small amount of time, less than 1 year, then it can be treated as a normal rent. And similarly, if the lease is for a low value asset, then it can be treated as a normal rent. Now, in case of lessor, we have an entirely different situation. We have a concept of an operating lease and a finance lease, but the concept is really somehow the same. The operating lease is where we treat a lease agreement as a rental agreement, where each year or each period, whenever the lessor receives the rent, that rent is treated completely as a rental income, as a lease income, and it the asset remains in the books of the lessor, which means it's a simple rental transaction. However, in case of finance lease, it is transacted as if the lessor has sold that asset on credit to the lessee and received the payments of the lessee with interest. So it is the counterpart of the lease treatment of the lessee. So how do we decide whether a lease is a finance lease and or an operating lease? So IFRS 16 gives a very rich guidance as to how to decide that, and it basically says that when substantially all the risks and rewards of ownership have been transferred to the lessee, then it would be considered a finance lease. Basically, it's saying that when the entire asset is substantially sold to the lessee in substance, then it would be considered a finance lease. Now, what are the situations? The standard gives us the examples of situations that individually or in combination with other examples, with other of these examples, would normally lead to a lease being classified as a finance lease. Now, what are those examples? First, the lease transfers the ownership of the underlying asset to the lessee by the end of the lease term. So, if the lease contract transfers the ownership to the lessee, then obviously we would assume that lessee has substantially assumed all the risks and rewards of the assets. Second, the lessee has the option to purchase the underlying asset at a price that is expected to be sufficiently lower than the fair value at the date the option becomes exercisable, for it to be reasonably certain at the inception date that the option will be exercised. So basically, this means that if the two parties have decided that the lessor would actually sell the asset to the lessee at a very low price in the future, and when making that contract, we can see that in advance that in the future that price would be too low for the market price, and it's very reasonable that the lessee will exercise that option. So in that case, it would be assumed that really the lessee is receiving the asset entirely. And third is that the lease term is for the major part of the economic life of the underlying asset, even if the title is not transferred. So the previous two cases we talked about were where either lessee was required to purchase the asset, or because of the low price he was expected to purchase the asset. But in this case, we are saying that if, for example, if the lease term is for 9 years and the life of the asset is for 10 years, then, and obviously life of the asset means the non-cancelable period where the lessor cannot interrupt the use of the asset. So if that asset is being used uninterrupted by the lessee for 90% of useful life, which means all the benefits and all the risk and all the rewards of that asset would be consumed by the lessee, So it is in substance as if the lessor had entirely sold that asset. This would not be the case if that same asset was leased out to the lessee for 5 years or less. Uh, so it has to be substantially a major part of the economic life of the asset. Then the fourth situation would be at the inception date, the present value of the lease payments amount to at least substantially all of the fair value of the underlying asset. So if the fair value of an underlying asset is $100, then the present value of all the lease payments is $99, then we would assume that because the lease payments have entirely covered the fair value of the asset, it is like really selling that asset. It's really like purchasing the asset from the point of view of the lessee and selling that asset from the point of the lessor, because the entire fair value would eventually be received net of the interest payment, which are in addition to that price. And last case is the underlying asset is of such a specialized nature that only the lessee can use it without major modifications. So if the lease asset is such that it has been specifically designed for the lessee, then obviously we are more likely to assume that the lessee will have obtained all the risks and rewards of the asset. Now these were the examples of situations which are very likely to lead to a lease being a finance lease, but there are some additional indicators of situations that individually or in combination could also lead to a lease being classified as a finance lease. And these are, firstly, if the lessee can cancel the lease, the lessor's losses associated with the cancellation are borne by the lessee, which means it is basically a restriction on cancellation on lease by the lessee. If the lessee cancels that lease, the lessor's losses will also have to be borne by the lessee, which means the lessee is actually acquiring additional risk and rewards related to that asset. Gains or losses from the fluctuation in the fair value, the residual value, accrue to the lessee. Now, for example, if the fair value of the asset goes up or down, the benefit or the loss of that fluctuation in value of the asset is actually borne by the lessee, then we would assume that it's more likely that the lessee has actually purchased the asset. Why? Because the risk and rewards which are associated with the asset's fluctuation in value would be borne by the lessee. And lastly, the lessee has the ability to continue the lease for a secondary period at a rent that is substantially lower than market rent. So if there's a secondary period, for example, if the useful life of the asset is 10 years and the initial period decided for the lease was 5 years, but the lessee also has a right to extend that lease to after 5 years for 4 more years at a much lower price in the market, then it would be assumed that the lessee has actually obtained significantly all the risk and rewards of the asset. So when the lease is a finance lease, and then as we said that the lessor will have to account for the lease transaction as a sell of the asset on credit and receipt of the payment as liability and interest expense. And if it is not a finance lease, then it would be an operating lease, and operating lease means it's a simple rental income on the part of the lessor.